Okay, folks, welcome to Volume 5 of the Inner Circle Traders Market Maker Collection. Okay, in this installment, we're going to be dealing with more insights as it relates to institutional order flow and specifically on mitigation blocks. Okay, the ability to discern when and how financial markets will move can be confusing. Now, there is a fundamental point that first must be understood concerning price on any asset class. This foundation is that large financial entities such as central banks, private institutions, and companies have a large influence on the action seen in price. Institutional order flow is the concept that we analyze the market structure and environment with on any asset class that we elect to speculate in. Now, before we lean on the tenets of traditional and technical analysis, we first must determine who would benefit from such a price action, move up or down. We will be covering some of those concepts I've employed at the time of this presentation over the last 2 decades. Some of this material may unsettle you. Some might shock your treasured opinions on how the marketplace trades in what appears to be a free marketplace. I make no apologies for telling you the hard truth and how it plays out daily in the market. Okay, understanding ICT institutional order flow. Now, when we talk about institutional order flow, it really it's been a little bit of a challenge as it relates to dissecting it in a way where you guys can understand it. Uh, when you're only exposed to the retail side of it, it's a little difficult to you know come away from the charts from just outside of indicator-based in analysis or input into your own trading plan. But when you look at institutional order flow, as I like to refer to it in all of my material, I made it in such a way in this presentation to break it down into four major spectrums. Okay, the first obviously is understanding that when we look at price, we are not looking at the retail universe moving price. Again, it's deep pockets that make these markets move, and we want to basically looking at the market when these individuals or entities come to the marketplace to take a trade. Now, the first segment of institutional order flow is obviously the business transaction side, and this is primarily focused on commerce. For instance, if IBM wants to do business in Japan, they have to convert their dollars to yen to do business with that particular country or within its borders. Um, the next realm of institutional order flow is obviously in speculation. We like to see a neutralization of speculators in the marketplace because as we discussed in the previous module in this series, we understand that stop runs and raids on stop loss orders can produce a injection of volatility that we like to use to fuel our trades. The next spectrum of institutional order flow is that fact that it provides liquidity. Okay, and the price action that we are studying, okay, we're looking for clues as to where the market may be looking to absorb new liquidity or inject or engineer, as we'll learn in this particular module, new liquidity. And the primary function of that is to manipulate price, okay? Because if they can manipulate price, that will incite all types of traders to the marketplace, whether it be bear or bull. It doesn't make a difference to them. They just need the volatility to induce new buyers or sellers. And the last in the spectrum that we understand as an institutional order flow is the fund flows. In other words, the major hedge funds and institutional funds, when they're in their trend following course of action in their trading model and plan, um, the smart money will be hedging against that. And you'll see that also in institutional order flow. So all these components collectively is what we like to break down and digest price action with. Okay, so it's not limited to just looking at a support and resistance. It's not limited to just looking at an ICT optimal trade entry pattern or ICT reflection or any of that. It's not even um, important without having the understanding of why should the price move and what institutional basis is behind the supposed move that you're looking to partake in. So when you're engaging the market, you're not going to be looking for, a neon sign or a billboard saying, "Hey, look, here it is." But they do, in price action, leave telltale signs of what it is that you're trying to do and induce new liquidity or neutralize existing liquidity to take on those positions themselves. Okay, so by studying the concepts that we've already employed in the first part of this series and the new material that we're reducing to into smaller components, that will be a huge increase in your understanding and growth as an insightful trader. Okay, institutional order flow. We're going to be specifically dealing with a multitude of specific concepts in this module, and while we will be introducing them here, we will be utilizing them in a much more framed approach in later videos in this series when it gets to specific trading tactics like day trading and short-term trading and such. But the first one we're going to be talking about is pools of liquidity or liquidity pools. I introduced this concept on Baby Pips back in 2010. And if you've followed me for a number of years, I talked about how above previous highs and lows and previous daily highs and lows, there will be pools of liquidity that they'll many times reach into to draw new traders in or pull them out of existing positions to facilitate new price swings. And we're going to talk in a little bit more detail about that and how it is useful to us in institutional order flow. And we're going to talk about voids of liquidity. Okay, when price action is very thin, okay, it creates a liquidity void, and what will happen is that insight is very, very useful to us, especially if we have a directional premise, because we will not be chasing that price action, but we will be utilizing it to frame a future trade should certain components fall into place, and we'll discuss that second in this series installment. We're going to talk about injecting liquidity. How do market makers do that? What's the function behind them injecting new liquidity? And we're going to be talking about neutralizing open float. And we're going to talk specifically what about float and what is it? And neutralizing pending float. We're going to show the idea how market makers engineer liquidity. Okay, and more or less, it's almost like remote control for retail traders and less informed traders, how they can basically steer them into taking a trade that's really in the wrong side of the marketplace. And controlling the board, how the market makers control the entire FX universe by controlling the majors. Okay, and crouching outside the order block. When we talk about the central bank dealers range and Asian range and consolidations, when there's equilibrium in price action, many times that's a telltale sign that we're about to engage a new order block, and that will be the catalyst for the new surge in price. And we'll talk more about that in this particular installment. And obviously the central bank dealers range, as I just commented on, we're going to be talking about that, what goes on during that time of day. And institutional pricing, how to specifically hone in on the actual price levels that we like to look at when it deals with institutional order blocks or in larger consolidations. And we will be discussing the mitigation block. And finally, in this video, we will be closing it with the introduction to the breaker. Okay, when we look at price action on a chart, and in this example here we have the British pound USD, or what we like to commonly call the cable. This is a 4-hour chart, and I just basically just reached into the chart, or data rather, and just pulled out a nice chunk of price action just to kind of like give you something to look at as we discuss liquidity pools. Now, when we look at price action, okay, the general consensus among new traders is they believe they have to go to a trend line, okay, and start connecting successive highs and successive lows, and try to understand where the next buy is going to be based on a retouch of that trend line up or down. Obviously, I'm not a fan of trend lines because they do lull you into believing that it's It's just that simple, and many times it does work. And that's the fallacy of majority of traditional technical analysis, because we can, and I can do this very easily just like anybody else can. I can go back on the left side of the chart and show you ultimate examples of how RSI and stochastics and trendline and MACD signals gave all kinds of wonderful trades, but the eye generally will not pick up on the times when it's not working. Okay, but it's very easy to see when you're taking those trades and they lose, isn't it? So it's very evident once we absorb a loss, we can look back and say, well, wow, that really didn't work. The the idea of institutional order flow, okay, really gets down to the core of what is taking place in price action now and what are we anticipating based on that in the future. Not just necessarily in the next session intraday or the next trading day, but for many weeks and sometimes months and years we can anticipate that based on institutional order flow. Depending upon the higher time frame basis, whether you're looking at a monthly, a weekly, or a daily, those insights are lasting across all lower time frame intraday basis trades, whether it be a 1 minute, 5 minute, 15 minute, or sub 60 minutes, if you will. But when we look at price action, the number one thing that I introduced as a precursor to all of the material that I was going to uh, unleash on the foreign exchange universe back on Baby Pips in 2010, I had encouraged everyone to look at when previous highs and lows, and many times previous daily highs and lows, when they are pierced, okay, and there's a quick rejection and it runs away and goes the opposite direction, okay, many times what that is a stop rate, okay, but primarily what that is, it's reaching into a pool of existing liquidity, okay, and what do I mean by that? Well, above previous highs, okay, generally you'll see a pool of buy stops. Now those buy stops may be in the form of buyers that want to assume a new long position, or many times they'll be in the form of a buy stop protecting existing short positions. Okay, but if you know majority of the retail universe, they are lulled into believing that the breakout system or approach to trading is just the easiest way. And it really is the lazy man's approach to trading, because you really don't have to think about too much. You just bracket the market. If it goes above a previous high, you buy it. If it goes below a previous low, you sell it, right? And if you do that with a higher time frame trend in mind or a directional premise, if you're right and you hold on to those positions, they can be quite profitable. But many times the false breakouts are a killer and it chews up the retail universe. So what we like to do is trained train the new trader, okay, and this is how I started my whole excursion as it relates to being a mentor in foreign exchange. I wanted folks to, when they look at price action or look at charts, and it doesn't matter what time frame you're looking at, and again, this is a 4-hour chart. What I want folks to do is look at highs and lows in the chart. Okay, I don't care so much about the trend. I don't care so much about the overall direction. Okay, even though we can look at this and clearly see that it has a very strong bullish market trend that's making higher highs and higher lows, and that's the classic you know bull market scenario. But I want you to more specifically look at how the market absorbs previous highs and previous lows and still can maintain the overall bullishness of the market. In other words, the cable was able to post a significant low in March. Then it rallied all the way up into a high in May. Okay, but prior to the low made in March and prior to the high made in May, there was plenty of opportunity in the form of day trading, intraday trading, and short-term trading, and even swing trading with the utilization of and understanding of liquidity pools. Now, it may not be clear to you now, but let me help you out with a little bit of a lipstick approach. Okay, and you can clearly see now, and I didn't note all of them, I just noted some, the salient ones, and I left some of them there so you can see for your own study. And what we're doing here is we're identifying the liquidity pools that reside above previous highs and below previous lows. You can clearly see when there is an X noted on the chart, okay, it's not too far after towards the right of that X, okay, price sweeps above a high and or just to the right of the X on the lows, price will sweep down below it and go the opposite direction. Now, if if you're a trader and you just are just hungry for trading signals and setups, um, this is one of the best ways to start a new trader's approach to seeing how signals and setups form consistently, very frequently. And again, this is on a 4-hour chart. Now, when you break these charts down into smaller components like a 15 or 1 hour, you'll see a whole lot more trades that you don't see here because it's just too much data, you know, condensed on the chart because it's a 4-hour basis. But you can see a lot of trades based on, what we're describing here. Now, if you understand how the market maker will dip into liquidity pools, okay, and if you have a primary directional premise that's bullish, okay, you can look at all of the X's, okay, that I have noted here that have the lows, or what we understand as sell stops, okay. Those particular lows with X's on them, they not too long after their notation here on the chart, if you go to the right of it eventually, not too long after that again, you'll see that that X, or that low, will be swept. Okay, there'll be a lower low taking out the low that's indicated with an X. Now, what that's indicating, okay, is that the market makers are driving price down to absorb all of the liquidity that rests underneath those lows. If we're in a primary bullish market, okay, as the market makes higher highs and higher lows, it goes without saying that those traders that are long, okay, and potentially profitable in the position, they're going to look to lock in those profits, okay. And what will happen is they'll find a particular low that they feel safe in, and they'll place their sell stop on their existing long position just underneath a low. That's not rocket science, okay? I mean, when you look at the price action on any chart, that's the first thing I want you to look for. Where is the money? Who's making money right now? And how easy would it be to take those individuals out? Because if we're going to go higher, the market makers will very much have an interest in taking the market lower to drive out and wash out bulls that are right or profitable, okay? Or lull new bears into the marketplace, okay, and try to get them to sell breakouts below the lows. And when they sell down there, the market makers are actually accumulating new long positions. Okay, so they'll be knocking out the existing longs, and they'll be accumulating new longs by, lulling in bears into a bear trap, and vice versa. Even while we do have the market, trading higher, there's still opportunities to see previous highs swept and then a retracement of sorts, where you can see that it's been profitable to see that. So again, looking at the multitude of just, you know a plethora of signals here, looking at previous highs being rated and then a retracement, okay? And if you're familiar with following my material, okay, this is the building blocks to one of the patterns I like to trade that I learned from the book Street Smarts, and it's titled the Turtle Soup Pattern. And it's a false breakout pattern. It's a break above the previous 20 bars high, or break below the previous 20 bar lows, and many times that's a really good contrarian trade. And again, it's not to make $1 million off of, but if you want a lot of trades, a lot of setups, and you're active, and that fits your persona, you can do a lot of that type of trading intra-week on a 15 or 60-minute basis. Okay, voids of liquidity. Okay, now what is that? Well, in Baby Pips in 2010, I discussed how price action, when it moves from large consolidations, okay, inside those consolidations on any time frame, but preferably on an hourly or higher, it's very easy to see there. The consolidation is where smart money accumulates their position. Okay, and during those periods of equilibrium, when price action is in a narrow, consolidated little congestion, okay, most retail traders are not excited about that. They're not looking at that, okay? But that's exactly when the market makers are doing their business. Okay, they're accumulating longs or shorts. Okay, now in these periods of price action, you know, by means of a lopsided order flow, which creates pores, wakes, or gaps in fills, okay, you get these voids of liquidity, okay? And what will happen is, in this example here, everything I'm showing you in this example can obviously, much like everything else I teach, just reverse every rule, okay? And it's the same thing for the sell side, okay? I'm just trying to save a little bit of time and make it a little bit more, uh, you know, easier to get through the material because these videos can be lengthy. Now, inside the consolidation, okay, they'll accumulate long positions, okay? Now, eventually, when that long position is accumulated to the point where just their sheer vastness of purchasing it drives price higher, okay? As price starts to move higher, okay, it leaves a wake of porous price fills, okay? So as that price rally ensues, okay, retail traders will be chasing it because they're going to feel like they're missing the next 200 pip move. But the smart money will not be trying to buy more of it as it does this rally. Okay, they're going to look to average in more at a more appropriate price level. Okay, now the market is going to slip to the only available trade levels as a result of thin liquidity. As these voids in liquidity will be revisited at a later time. In other words, what I'm saying is the market will seek to fill in any gaps or missing levels on trade. Now, the impulse price swings are typically seen with these voids of liquidity. So in other words, when you see a quick surge in price higher or lower, okay, generally when it moves out of consolidation or equilibrium price point, okay, much like we talk about when we discussed the central bank dealers range and the Asian range, when you see these consolidations, that's your tip off. That's exactly when the dealers and smart money and market makers are actually doing all their dirty work. This rally higher, again, this is going to house what we call a liquidity void. Now the void is when you see that price action there, it looks like there's a trade at every potential price point from the low to the high, but there really isn't. If you go down to a really small time frame, you'll see that there's very little trading going on. Okay, so what will happen is, just like in classical technical analysis, when you see gaps, okay, the common order of things is we expect to see the gap get filled. Well, that same thing happens in price action. Okay, it's the same thing. It's nothing new. Okay, nothing new under the sun here. Okay, but the understanding of what it's doing is important to us. Okay, because if we anticipate the bullishness of a market move, and then we see this, okay, we may sometimes not be in the position as it takes off, and that's fine. We don't have to worry about it because they're like buses. Okay, they'll come back around and you'll get the next one, and that's what we're going to kind of like get you to think about here. Now you can be a bear and sell into that surge higher. You can do that, okay, and with the anticipation of seeing a retrace back into the impulse move. But that's not my style of trading. But I do employ that approach with looking for exits when I do trade short with the market maker sell profile. Okay, and we'll talk about that in the next two video series installments. We'll be dealing specifically with the market maker sell and buy profiles. When we see the surge out of the equilibrium and consolidation area, we want to identify the bullish order block. Okay, and what will happen is in this example here, I actually went to a higher time frame to actually pull out what the order block was, but I'm noting it here, and you'll see an example later on how this is done also on more friendly charts. You can see specifically, but this is really taking out real price action. I'm not just making this with paint or anything like that. No, but we identify the order block, so we understand that there is the high probability for this impulse move to pull back and fill in all of the porous wake or gaps in all of that price action as it rallies high, because the speed at which it moved did not permit the market to trade, okay, at a level of efficiency to provide trades at all of the available price points between the order block that's being described here and the high of the impulse leg. Okay, so there's going to be a lot of potential areas that those prices could have been traded at, but it moved too quick to facilitate that happening in price. Now, Again, we look to anticipate the range to fill in and the liquidity void be closed up. Okay, in other words, all those porous wakes and gaps in at that price surge, we're looking for that to come back and fill in all that. Okay, this is trading inside the range concept. Okay, all we're doing is specifically looking for the components of what that entails. Like what is it we're looking for? Okay, and that's what this whole video series is doing. Now it's pulling all my concepts together in a cohesive approach to doing everything in a systematic way, but having all the concepts in concert with one another. That's what you see when I talk about specific moves, and I call moves and show moves and give results of particular trades I was either in or any setups that may have come across through Twitter. Okay, all those things, once we're done doing this video series, you go back and look at it, you'll understand clearly what was the catalyst that was leading into those. But once the price action does in fact come back down and rejoins the consolidation back into the previous bullish order block, that's when we classically view it as an ICT pupil, okay, as a range fulfilled. Okay, so it's a filled range. Okay, so now we're trading inside the range. This now becomes what? What do you think would happen as a result of that? What can we use right now as price does this? It's slamming right back down into that orange line, which we indicated as a bullish order block. When price does that, we have filled the liquidity void and fulfilled the range. New accumulation of longs is what's taking place right there. As that candle is bearish and bold, plowing into that existing equilibrium consolidation area, when you see that, okay, we know that there's a high probability of a reaction there on the long side, especially if it's a primary bullishness to the marketplace that we're looking at, and it's a time of day to be indicative of a surge in liquidity. And as a result, price pulls off of it on that candle when it hit the order block and created a little bit of a wick. But then as a result, later on, its price surges away. Okay, and that is how we use liquidity voids, and we anticipate price action when market action is very thin. Again, we don't chase it. We don't fear missing the move. We go into the marketplace. We identify where the previous point of equilibrium is, or the consolidation. We identify the order block or the institutional price point at which we want to be trading at, and then wait for price to come back down into it. And we can place limit orders around that area to be a buyer. Okay, and if you look at where we are in terms of where that order block would be in the consolidation, where the low would be in that consolidation, many times that risk is very, very small, especially if you've trimmed down your time frame down to like a 5 or 15 minute basis. You can get sometimes a 10 to 15, 20 pip stop. I still like to advocate a 30 pip stop, especially if you're trading London, because typically that's about 1/3 of the average daily range if you consider 100 pips as an average daily range. And I know many times it's not 100 pips, but we'll talk more specifically about that when we get into the day trading and swing trading and such. We'll talk about all that. But just for now, just understand that when we look for quick moves in price action like this, up or down, okay, this is how we go into it. This is what we're looking for. So now, just with this alone, now you understand what it is that you are looking for in price action as a foundational basis. Okay, when we see these movements, okay, assume that consolidation at the low was a liquidity pool. Okay, and then price rallied away and started going higher. It creates a liquidity void. Well, as a trader, we can now anticipate that retracement back into the consolidation to do what? Accumulate new long positions. So now what are we doing then? Are we trying to call the bottom? No, we're not. We anticipate that. We wait for it to occur, and then we gingerly walk over there and pick up the knife once it's sticking in the ground and stops quivering. Then you can pick it up. Otherwise, you're catching falling daggers. In this example here, what we're doing is we're getting VIP pricing, and we're like joining the big dog. We're that flea on its back trying to run with it. Okay, because that's the only way we're going to do it, because we're too small and our legs are too short to keep up with them. Okay, we're going to be looking at how market makers inject liquidity, and it's primarily by function of what I call a Judas swing. And what will happen is we'll use an example of here. Um, the vertical lines that you're seeing here on the chart is delineating midnight time frame in New York. Okay, so whenever you see that, understand that's what we're looking at. Okay, see, 5 GMT. Now what we're suggesting here is when the market sees a surge down in price, retail traders, okay, and existing orders that are laying out in the marketplace, okay, will quickly be triggered, and market orders will be utilized by those that are just sitting by their charts and they see it dropping like this. They'll get in there and start selling it right as it starts to drop. Okay, many times when you see these big down candles, okay, it wicked here, but at one point this was a bold bearish candle. Many times the retail universe would be selling right down in here. Okay, and then what will happen is many times the market makers will take price back up, clear out an existing area of stops, okay, and up here this would be considered like a double top, okay, or they like to see that as a short-term little shelf in price, okay. They call it a safe place to look for shorts, okay, and place their stops at. So as the price was dropping, if they were profitable, their buy stop on that short would be resting just above this area here. And you can see clearly they did in fact come back and swept that area, and then the real price action took place later on. The same thing happens here. We're in a consolidation. Okay, price action drives down lower quickly. Okay, this injects a lot of liquidity. In other words, it creates a lot of participants wanting to sell, 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 sell. And what will happen is this price will turn on a dime and rally the other direction and clean out the level prior to its inception moving lower. Okay, so again, this is a nice little short-term double top. Okay, and this is exactly where retail traders are trained to place their stop like good little slaves, and eventually they are rated as you see here. Okay, on the buy side, okay, you can see the same thing here. We have a consolidation. The market makers drive price lower a couple different times. They do this, okay, and prior to it moving higher, a lot of individuals would have been looking for this to go lower because we've broken rather a couple different short-term lows here, okay, and the breakout guys would be all in on this looking to go short, and it's exactly why the market makers would drive price down into this level, because it would be to inject liquidity, okay, that may or may not actually be there. Maybe there wasn't a lot of um, initial sell stops underneath these lows. Okay, even though there was a clear pattern to suggest it. Okay, and they had a lot of trap basis, along the price action you see here, because it's very clean levels. Okay, but look at the fact that it had to go down there several times to do that. I believe that's the reason why the market makers were doing this, because it needed to constantly drive down there lower and making people believe by looking at these lows that, yeah, okay, now it finally broke it, it's going to continue lower, and in fact they put the brakes on it and then jammed it higher. Okay, so whenever you see the market shoot up, okay, in a rapid succession, again, much like we just talked about with a liquidity pool, okay, that is going to inject a lot of liquidity and a lot of excitement about that particular move or that market or that asset class, and the retail universe will dogpile on it, and they'll be all in it, as it's moving higher, moving lower in the heat of the moment. So dealers and market makers will do that to, again, get excitement drawn to a particular market asset class, and to get an interest. Okay, it's kind of like when you go to a carnival and you see the guys that are saying, hey, come on, $1 you get 3 tries, hit the steel cans off the pedestal, that type of thing, and they try to get you to come in, and they bring you into the game. Well, that's what the market makers will do with a quick price surge. It's not always just a lot of big buying going on, okay, and as we'll see later on when we look at mitigation blocks and breakers. A lot of times it's just a trick, okay, to lull you into believing there's a real move underway. Well, there is. It's just many times the opposite direction. Okay, we're going to look at now how market makers neutralize the open float. Okay, now what is the open float? Well, when I say float, okay, what I'm saying is kind of like think of it as open interest. Okay, open interest, not in the capacity like in the futures market, okay, but an open interest or an attention, if you will, on the particular market or pair. We're going to specifically deal in the conversation as it relates to for this uh, setting. It's going to be the Euro USD or fiber as we call it in FX. And we're going to look at the 15-minute chart here. And what we're saying is that to take out the open float would be an example of like this. Okay, we have the market making a nice high here. Okay, and pull up and give it a retracement. Okay, and maybe on a smaller time frame this could have been a sell scenario for someone else. It doesn't make a difference. That's not really not concerned here, but the fact that we drove down rather quickly, okay, this was now an existing open position, okay, for folks that would have been bearish. Okay, now if the market makers are inclined to want to assume a short position, maybe that was their initial entry, taking out this previous high in here. Okay, let's assume that's the case here. Okay, because we're never really going to know the fine details as to what it is. Okay, we're going to speculate with the high probability of the patterns and the tactics and tricks that they use as I'm teaching in this series, but over a period of time, you'll start seeing that they're very classic. They repeat themselves. They're very generic. They happen almost on a daily basis. Not to say that you have to trade every single day, but you should at least study your particular pairs, or at least the majors, on a daily basis. Mark your charts out like we're showing here. Okay, and you'll clearly see, you'll have a lot of experience seeing the patterns over and over again repeating. And it's the only way you're going to be able to have the foresight triggered when you see it real time. Okay, because there's no other way around it. You got to do the legwork and got to do the homework. But assume this is the high they sold into initially. Okay, so the market makers were assuming short positions. Because they have deep pockets, they can sell early. Okay, they can sell early. So they established the framework, if you will. So the premise or basis for the market is now going to go lower. So they sold off and it starts to drop here. Okay, this high is now important because it had a very quick surge lower. Much more important than this one. See how this is muddy, just meandered lower. Okay, this high was much more significant. If we note this high, as we do here, price goes into a consolidation. Now, these two levels in here are my ICT Asian range. The Asian range, as I define it, is 0 GMT to 5 GMT, which is basically midnight New York time. Okay, and what we like to see is price consolidate like this. When it does this, okay, that is a huge tip-off that you're going to have a really, really cherry setup going to the London Open. And many times, if you break it down on a smaller time frame, you can see the same effect in New York Open, as we'll discuss later in this series. But as it relates, there's going to be folks that may have been right at the same time the market makers had maybe sold into this high. So they're profitable in here. Okay, then we go into consolidation. Where's the stops going to be? Right above this high. What kind of stops are they going to be? Buy stops. Well, why do I know that? Well, folks that are seeing it trade higher in consolidation here, they're going to see, oh, if it breaks above this high, chances are it's probably going to trade higher and continue moving higher. So they want to be a buyer on a buy stop, on a breakout. Those that are short on the marketplace, okay, they are going to place a buy stop to protect their existing short position. Now, the market makers are not using stop loss orders. Okay, write that down in your notebook. Market makers are not using hard stops. Their pockets are way deeper than ours, and they are the market. So when we talk about market makers, okay, these guys are not putting stop loss orders above and below previous highs and lows. That's not their game. Their game is to take the stops that are resting above and below those previous highs and lows. Okay, that's why if you look at any chart and you staring right in the face here, previous highs and lows are getting taken out and going the other way after it does it. Okay, so now how does the market maker neutralize the open float? The open float at this point in here, okay, is short. Okay, the float is short. How do I know that? The fact that they ran the price above the previous high right after midnight, okay? When they do that, what they're doing is they're sending a Judas swing up, getting people, what, excited about buying the market. But what's it really doing? It's seeking a pool of liquidity resting above this high. What is that? It's a stop pocket. there is a bunch of stops in the form of buy stops right there. That's exactly how they're going to neutralize the open float on the existing shorts right here. They neutralize those shorts right there. And as a bonus, they suck in all of the breakout bulls that's going to get now slaughtered. And they readjust price and it goes lower, taking out lower lows, lower lows, lower lows, lower lows. Okay, and ultimately making a rather profitable day. And here, the contrarian side of things, we got into a consolidation here. Okay, and price. What has price been doing? Not just looking at here, okay, because we'll talk about when the real Judas occurs. Price has been dropping. Okay, so now what's going to happen? Folks are going to look to go short. Why? Because look at this big price action. It's just like anything else. Wherever there's action, there's a crowd going to form. Okay, it's like a fight. If you go, remember your days in school, if a fist fight broke out, it didn't take very long for a crowd of people to just move around those individuals and start screaming fight, fight, fight. Their excitement, okay, would be increased. Well, the same thing's happening here. Now we've moved into consolidation. The crowd's forming. So what do they anticipate? They anticipate a move doing what? Going lower. Well, what's the market maker going to do? Oblige them, okay, and shoot price lower. There's your impulse move, dropping lower, your Judas swing to lull into the sense of excitement again, okay? But what's it really doing? Okay, what's it really doing? Behind the curtain, what's the Wizard of Oz actually doing here? Seeking liquidity, okay? He's injecting liquidity by the Judas swing, getting people all excited, going down and taking out a previous low, neutralizing, okay, neutralizing those individuals that may have been maybe looking at this as a buying opportunity, because look what it's been doing. See how it's going higher, making a higher low, and boom. This rally in here, okay, maybe incited new buyers, okay, new buyers in here. So those buyers here are going to get crushed here, because where would they place their stop loss order? Down here. What kind of stop would it be? A buy stop. Why would it be a buy stop? Because they're protecting, I'm sorry, a sell stop rather. It would be a sell stop below here, protecting this existing long in here, because maybe they viewed this as a retracement in an overall bullish scenario. Dealers will take price down below the previous lows here, clearing out their sell stops on existing longs. Okay. In this picture here, as we have price dropping lower, the participants that want to get involved going short, okay, would have looked at these equal highs in here, okay, maybe back in here, thinking it's a good place to place their buy stop to protect a short position they might assume, okay, and price is driven higher, neutralizing the open float on those traders, driving price lower to get excitement. Why? Because the real money's going to be made on the long side, not this. The real money's going to be made on the long side. Taking out this low here, okay, with stops resting below it. What kind of stops? Sell stops. Because breakout artists are going to look for this to continue lower because they liked this action in here. So the float, okay, in here is all on what side? Well, when we see the move driving aggressively down like this, reaching below this low, it's a tip-off that the float is now looking to do what? Be sellers. Okay, so how are they going to neutralize that? Well, they run the low, suck them in, and those sell stops on existing longs that try to catch the low here are going to place buy stops. I'm sorry, sell stops on their longs, and a breakout player looking to break below this low would have sell stops. Okay, trying to catch momentum trades. Okay, so the dealers are taking it right below that low for what? To incite a form of market action in the form of selling, making those sell stops become market orders to sell at the market. Why would they want that? Because they want to buy it up there. Okay, so they neutralized both participants in both sides of the marketplace, and then the market took off and did what it was going to do all along. Okay, where does it ultimately go? Up to this high right here, right? What's going on with this high? See this high here? It blows through the high and then trades off. Now this is all inside the same overall price swing, okay, but generally it swept an old high, okay. This would be an excellent area to take profits on a long. But now look closer. Remember this high back here? What are they doing now? What did they just do there? Well, they sold back here, right? Remember we were talking about how they sold? When they drove it down to this level here, below this low here, that was their collapsing of the shorts that they assumed here. They accumulated short positions by blowing out the stops here. They accumulated longs and collapsed the shorts assumed here by breaking below this low here. So see what they're doing? They're taking both sides of the marketplace, neutralizing the open float, but still working within a model where they're profitable because they swept those stops that would have been resting above here and any liquidity that would be resting in a liquidity pool. Okay, so that's how ultimately the market makers will neutralize the open float. Again, open float are existing real trades that are in the marketplace. Okay, now what we're going to talk about is how the market makers neutralize pending float. Okay, what does that mean? How do dealers neutralize pending float? Well, if you look at what we have here, okay, we have a lot of whipsaw back and forth. Okay, there is a market profile that I released in 2010, and it is the seek and destroy profile. Now, this concept is not new. It's not like something I created and I didn't even author it. I just took it from my earlier learning from George Angel as it relates to S&P 500 day trading. And he talked about how there was like maybe 4 times a month there would be a day that would just go up and down crazily, taking out previous highs and previous lows intraday and really just making a mess of things. And it's very, very difficult to make money in those types of days. And this is one of those scenarios where every low, okay, and every high made for the day is both swept. Now, ultimately, in this case here, we did continue a little bit higher, but this is how the market can go back and forth and neutralize any pending orders and then more or less trap traders in a consolidation or a holding pattern. And many times you'll see this type of formation, okay, or similar seek and destroy price action where it's up, down, consolidation day. They can be traded and faded, but generally I don't like to do that. And unfortunately, they do tend to open up initially as a really good day, but then it goes to crap rather quickly. So understand that if you trade at any length of time, you will be involved in an area of trading where your pending orders get snapped into the marketplace and it goes back to the middle and generally stays in the middle of the range. In both positions, the buyers above and below, okay, will be held in a state of limbo. And generally, like I started to say earlier, you'll see that generally happen around the first week of the month, going into non-farm payroll, because that's classic non-farm payroll week price action. Okay, now we're going to look at engineering liquidity. Okay, we have this is a good example of the neutralizing pending orders. We have price in a consolidation here, trades up, okay, takes in buyers or sellers, doesn't make a difference, okay, by blowing out previous highs, trades down, takes out a previous low, and trades into an old swing low in here. And then what does it do? It trades right back up, doesn't break out this high here, and then consolidates going into the day. Okay, so this is a consolidation day. Okay, consolidation day, or Z day as I call it, because it doesn't really take out over and over again intraday highs and lows, but it does create a Z formation where it just goes up and down and just goes nowhere. Okay, when we see that, okay, we know that there's a really good move on on the horizon. Okay, and especially if we start seeing a consolidation going into the Asian range, as we see here. Now, what do you think? What do you think, looking at the chart as we have here, what do you think would be expected if you were a market maker? What are you going to anticipate the retail universe doing? How are they going to view the marketplace? Again, because the multitude of them are breakout traders, they're going to be looking to do what? Above the Asian range or consolidation, okay, because most of them are, you know, they work 9 to 5, they got jobs or whatever. They can't be really in front of the charts all the time. So they've read in a book or on a forum somewhere that if you do these types of things, you can catch really good trades. And if it breaks above, they want to buy. If it breaks below, they want to sell. And if you look at all of the retail junk that's sold in terms of literature, this is kind of like they teach this stuff. And there's like a real big surge of it again over there at a well-known teaching retail website. And they're really pushing this whole breakout concept stuff like it's revolutionary. Looking at what we have here, okay, if price moves out of the consolidation and drives higher like that, okay, see what they've done? Okay, see what they did there? They blew up the market, making all the buy stops go active. Where would the sell stops be? Below the market, Asian range low, inside that red area. Okay, now traders that are waiting to be a seller down there, we're going to wait, and their pending orders will be sitting there waiting in the marketplace. Okay, right about now, the buyers are thinking, man, we covered our dealer spread. Okay, now we're going to be really, waiting to see this thing take off, and we're going to be in the money. All of a sudden, there's a shift in market structure, and the market dips below the Asian range low. So now those participants that were long, that went long, where are they gonna place their stop loss? Below this consolidation in here, okay? Because they believe that's some sort of a protective shelf or short-term low or support level, okay? That's exactly what the market maker tries to incite. When price dips below the Asian range lows like this, okay, the only thing that's doing is neutralizing the initial longs. What is that telling us? That the long side was right. Okay, see what happened? The longs were going in market first, okay? The sell stops below the lows were triggered right here during London Open. The consolidation, okay? The consolidation leading up to the trend move. The initial buyers had to be neutralized. They got to be taken out of the marketplace because they're long. So now they have hard stops on their position. Okay, they are now the open float is what? Long. So how do they neutralize it? They got to take it below where the stops are going to be, the sell stops. So once those are down there, those sell stops are triggered. The longs that are long here that bought are going to break out. They're right, or maybe they bought it in consolidation. Who cares? But they're long. They have to, as a market maker, they want to unseat them from their position. Why would they want to do that? They want to assume their position. How can they do that? Well, they know they're going to put their stop loss below here. So they'll drive price below it. Once price goes down in here, the longs get sold out with sell stops that become market orders to sell at the marketplace. Exactly where market makers will accumulate long buy orders. They'll buy on the other side of those sell stops being activated. And you see the price action here. Boom, explodes. And that's the engineering of liquidity and how it takes place. They give the traders the initial cookie, if you will, okay, and get them to believe that it's there, okay, and they'll dogpile and put money into it, okay, and then take them out of the market quickly in London. When that takes place, you know the real move's right there, and it's going to take off and blow the other way. Now, I know most of you are thinking, well, how would I know if this isn't a Judas swing here, and this was going to be the beginning of a down day? Because you're going to have to look at the higher time frame premise. Are we in a bullish or bearish market profile? Are we in a buy program or sell program? Are we in an existing higher level bullish order block? Are we looking for higher prices longer term, intermediate term? All those things are going to lead up to, and I'm not trying to teach you the London Open Kill Zone trading, okay, here, because it'll steal the thunder from that video. But for now, I want you to look at price like this on a daily basis. Break down every single day like this. See what they took out prior to the big move of the day. Every day has a move. Every single day has one, okay? And there's two primary sessions of intraday trading. Every single day there's a London open session trade and there is a New York open session trade. Every single day. Now, majority of the time, they are in tandem with one another. If London posts a high, New York will trade in concert with that and make a continuation. But not always. Sometimes it's a reversal in New York. Okay? Or many times the move will be ended in New York and then it'll consolidate going into the close of London and maybe the New York session close, 1800 GMT. But primarily, okay, I want you to start studying price action like this and look how the market makers take out pre-existing highs and lows. Why would they have done that? The story's already in hard text in front of you if you just study the chart. I mean, the whole story is there. Now, granted, there's going to be a lot of you that are watching this saying, well, this is all hindsight stuff. It's all hindsight stuff. That's how I learned it. You got to look at it on a hindsight basis to get the grasp or come to grips rather, with what it is that you're going to be looking for going forward. If you have no idea what it is that it looks like, okay, you're never going to see it when it happens. It'll always be in the rearview mirror. Okay, but these are reoccurring themes and phenomena that take place over and over and over again. But every time you see a what would look like a double bottom, okay, or a double top, those things are just waiting for stops to build above it or below it, okay? And you can see, I mean, right in here, people will see this as after a move like this, they'll say, well, okay, my stop's protected under here. Well, where's it going? Right below it, right here. You can see it's going right to it, okay? This high here. See these two candles here? This is too clean. They will get raided. Boom. There it is. It's done. Okay. So when you look at price action, I really want you to start looking at it through the eyes of a market maker. If you had the ability to take traders out of positions, you know how they're going to place a stop because it's the same way you do it. Okay, above or below a previous high or low. It's exactly what the textbooks say. Okay, so having that mindset going into your trades, will be obviously beneficial, but until you develop the skill set that's needed to identify it real time, you're going to have to mark up your charts and just build a large sample size of data where you can see this phenomenon happening over and over and over again, and you'll be much more prepared to see the right side of your charts come to life in real time. Okay, now we're going to be talking about the concept of crouching outside of the order block. Now this is one of the strongest setups for if you're looking for like a London open kill zone type setup or a New York open kill zone setup or even a London close reversal profile setup. If we trade down or up into a higher time frame order block after a consolidation, okay, preferably around the Asian range or New York open consolidation we'll discuss later on in this series, when we see those events, okay, and we're going to look at the this one right in here, okay, we have this level delineating this down candle prior to the move up. Okay, you see that big surge up? We have a down candle here prior to this move up, but it's really triggered off of this one here. Okay, so we're underneath the high of this candle here. So at this time point, you really wouldn't be utilizing here, even though you're inside of the order block. Yes, the parent price swing begins here. So this is the bearish order. I'm sorry, the bearish candle, which is the bullish order block prior to the moving higher. So if price comes back down to that level, we would be interested in being buyers. Now, specifically, if you're looking at what we have here, we're going to go down to a smaller time frame, and we're going to see the concept take place right here. Now, when you look at price, okay, and more specifically right in here, this consolidation, this is what we're talking about when we're saying we're crouching right above an order block. Okay, so inside here, dealers are accumulating positions. Now, discussing what we had already mentioned earlier in the series and another ICT series, and what we discussed as it relates to injecting liquidity and taking the traders in on the wrong side of the marketplace. Okay, that's the Judas swing, which is what you see right here. Okay, look what it does. It goes right down into that order block. See what it does? Boom, trades down. This blue line down here, all it's doing is indicating that is the ICT London Open kill zone. Now, kill zone, okay, a lot of folks on the internet and YouTube have taken a lot of my key names for certain things and honestly used them differently. But a kill zone, an ICT kill zone, is specific time of day. Now, an ICT kill zone, okay, would be an area at which, like a higher time frame key support resistance level. Okay, that's a kill. That's a killing ground, if you will. A kill zone is time. Okay, and if we identify a higher time frame support resistance level, okay, that is an area where I would look for order blocks to form. And once the order block forms, then obviously it's a done deal. We know what we're going to be looking for. But a killing ground is just an ideal area to anticipate the order blocks to form. And then that confirms a support or resistance level. In this case, we identified the order block on a higher time frame, okay, and around that 125.04 level, give or take. But you see the precision as it was, price drives down in the London Open kill zone, okay, and what does it do? It makes the low of the day, surges, blows out the high of the Asian range, comes back down into it just for a moment, okay, just for a moment. And we're going to talk about this here in a second, but then surges on, continues through the New York session and making the high, well, the highest high here, but this is a nice high to exit. During this red time period here, that's the London close time, okay, and we like to take our profits in that particular time of the day. So you would be able to get the lion's portion of the move. Now we're going to talk about the institutional pricing. Okay, institutional pricing would be the level down here. Okay, we're looking at on the higher time frame order block was at 125.04 or thereabouts. Okay, I'm not gonna fine tune it there. We're just gonna monkey with it here. When we see that, okay, we know that there is a high probability for price to trade off of round numbers. Okay, prior to the big figure 125, 125.10, good price to trade. Look at the reactions here. We have the open of this candle here. We have the body of this candle here and the body of this candle here. Okay, look at the nice symmetry of price gathering around that particular level. Institutions were buying at 125.10. How do I know that? Because the majority of the action was right at that level. Okay, right on that level. Right in here, that 125.10 level very clearly indicates that there was trading by the institutions, because the bulk of the trading depicted by the bodies of the candle, okay, we don't spend so much time with the wicks, okay, but the bulk of the candle's bodies are gathering in multiple touches, okay, around that round number 125.10. So that would be a good indication to be a buyer right down, and as we swung lower into it, our buy order would be around that level and not so much around that 125.04. Now you can fancy dance and try to get lower, but many times you'll miss these trades, okay, and that's really an unfortunate thing when it happens, but that's, that's the breaks, if as they say. the the fact that we look for the higher level time frame order blocks when we see the consolidations in London Open and New York Open setups, okay, they are very, very strong precursors to how good the order block is going to be. Because if you start seeing the market makers holding price in a very narrow consolidation prior to or just above a bullish order block, or vice versa, up below a bearish order block, what that's doing is they're getting ready to pair orders up. Okay, and it's an old concept that I shared back in 2010 in an old live stream presentation. I'm trying to clear the audio up on it so you guys can go back and watch that all over again. But all the things I'm sharing to you now are higher level time frame, not higher level time frame, but higher level trading concepts that I wasn't sharing initially because you just don't have all the framework around knowing the things that you need to know looking for it. Okay, that lead up to their formation. But understand that when we have a higher time frame, monthly, weekly, daily, 4 hour, and 1 hour order block, if we are set up in a consolidation like this, and this can occur in London Open as well, I'm sorry, New York Open, not just the London Open. When we see these scenarios set up for signals for the London Open, okay, it's the Asian range we're talking specifically about, not London Open consolidation. It's the Asian range consolidation that we're looking for that prior to a bullish order block. So we would see and anticipate what? A Judas swing down into that order block. That's huge probabilities for an upside move, especially if you're overall bullish. Okay. Okay, we're going to talk about the central bank dealers range. Okay, and I had put a video out on YouTube. It's still there, and I really did it just to have it as a demarker for time when it was released because I know a lot of my stuff gets taken by other people and claim it's theirs. They've been doing it for 50 years because I've been doing it for 20, of course. But this is a concept that was shared with me by way of institutional traders that view the market like this. Okay, and they employ this information, and I'm more or less sharing it without their blessing. So let's just understand that what we're sharing here isn't in a book. It's not anything like that. It's not for sale anywhere, but I am giving it to you. So here you go. I want you to see there is a range, okay, that's being discovered, maybe for the first time for some of you, right here. And I want you to, for the moment, take your eyes away from that. Okay, and what this is showing is the range between 1900 GMT to 0 GMT. Okay, every day, generally, you'll see a very tight consolidation like that between those times. What's going on there is what's going on there during that time is the the dealers are looking at what's existing in the marketplace. In other words, where are all the open orders? Where's the float? What is the general consensus of the marketplace? And they're going to use this information going into London Open. Now, I know some of you are going to argue, well, Wellington is the new day. Well, it may be new day to you, but as it relates to the higher low of the marketplace for the 24-hour day, um, it doesn't mean much. It's too early in the day. But in here, when we're looking at price like this, we can fragment the day utilizing the central bank dealers range. And what this is doing is gives us areas of overbought, oversold without the utilization of price indicators. And what's happening here is this is the overall range, okay? And if we're bullish, okay, if we're bullish, we would anticipate what taking place going into the new day. We want to see a move going lower. Why? Because we learned that power 3 is we want to see the opening price and below it be our area where we like to do our hunting for longs. Okay, price does in fact, out of this consolidation, sweep below this low. It does it right here. Okay, it goes down how far? 2 standard deviations, just a little bit. One wick went a little bit below it, but you're taking the range that's between 1900 GMT and 0 GMT, and you're replicating that going down. Okay, I could go one more, but generally 3 deviations higher or lower, that's about the standard that the market will move, unless it's a very extrapolated move that's news driven. Okay, but in here, if we're looking to be a buyer down here, okay, how long can we hold on to that position? How long will they view intraday that range before it would cap it? Well, once we get on the other side of the central bank dealer's range, we have one standard deviation, two standard deviations, three. If I extend this out, right there is where they made the high of the day. And then what does it do? It goes into consolidation. Okay, you see that? So what we use the central bank dealer's range for is a measure of true overbought or oversold, and we look for areas to build the case for entry and exit, not just simply, you know, are we overbought or oversold on a stochastic or RSI, but more importantly, in terms of where we're at in this range. Now, what is going on here that's so important? Again, they're looking at what is existing in the marketplace right now. Is there a lot of buyers above this or a lot of sellers below this? Based on that knowledge that we're never going to have that real knowledge of what they can see, okay, or whatever the real order book is. And I'm not talking about your dealers or your brokers. I'm talking about the central bank level. They see all that stuff. They know what's out there. Okay, and you can argue with me all you want. I don't care what you believe, okay? When you get my result, then you can tell me something different. But right now, you're in my class, okay? So there's a little dose of ego for you guys that want to troll. The bottom line is this. If we're in consolidation like this, we anticipate a move down for buys, and we indicate that by a Judas swing, okay, going into a time of day. Well, the low of the day is formed right at the beginning of our blue line, which indicates the London Open. Kill zone. Boom, there's your buy, okay? ICT reflection, low to high, pull that down, you'll get this exactly on the low. I'm not going to do it to clear out the chart, but you can do that on your own. For now, just understand that the central bank dealer's range, okay, is a concept that we employ, and we will be doing more research and applications rather in the specifics about how I trade on swing trading, short-term trading, and intraday trading, okay, and we'll be able to utilize that information much more specifically. But for now, just understand that the central bank dealer's range gives us an overbought, oversold measure that's highly effective and never requires any reaching for an oscillator of any kind, and it's very precise. Just understand also that generally 3 standard deviations is a maximum, and generally you'll see that it's 1 standard deviation. Not in this case, here's 2, but I use this example to give it to you. Many times it's just 1 standard deviation where it drops down for the Judas, and then it'll make the low and then rally up and then do the standard deviations above the central bank dealer's range to give us an indication of how far higher it will move based on that buy, and just reverse it for sells. Okay.
Okay, folks, we're looking at the British Pound USD, so the 4-hour chart, and we're going to look at mitigation blocks now. Now, a mitigation block is something that is used. It's like an order block, but it's a reversal of roles, so to speak. Okay, as price started to make a high in here, it started breaking down market structure, as we see here. Okay, these lows were taken out right there. So as price starts to rally up, okay, and fails, okay, when price fails here, it drives lower, it breaks market structure once again. Okay, we have this low here, just slightly lower. Now we do not need a lower close. Okay, market structure by way of what I learned from Larry Williams 20 years ago or more, it does not require a lower close. When a low is taken out at a reversal time frame, in other words, when we anticipate a high to take place in the marketplace, this is all that's needed for a market structure shift. Okay, so now the market has a short-term high in here. Okay, see that? Short-term high. So stops would be resting just above this price point right there. Okay, they'll run price above one more time and then break lower. Now watch what takes place. Okay, we have another shift in price right here going lower. Okay, assume for a moment that you were not assume for a moment that you weren't astute enough to trade up in here, okay, and you were unable to catch the short here, but you did see the break in market structure here, and it really started to break down. We can sell the rally at a later time using the mitigation block. Mitigation blocks are, well, everyone can see clearly this is a swing low, and price rallied away, came back down into the order block right here on this candle here. Let me paint this for you. Follow along. You have the body of the candle. On the down candle here, the wick is not essential. The body of the candle is what's essential. And price comes down, dips into it here, and then rallies up. Okay. Then it rallies to what price? It rallies to the bearish order block, which is the bullish candle prior to the down move. Okay. Now look at the body of the candle. This is how we get institutional pricing. We move up to that price point right there. You see that? Price comes right up into it. See how handsomely that's done? Boom, 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 and then finally gets up to ghost. Now, assume for a moment you are not able to get that, and that's fair. I mean, everyone can assume, eventually they'll do well and get that accurate, but it's going to take some time. If we see the market structure break, okay, the folks that bought here in smart money, okay, the folks that bought here, in the smart money camp, okay, that drove price higher here, when it gave up the ghost and broke this low, okay, they're in a losing position there. But remember, we learned earlier that smart money does not use stops because their pockets are deep and they work within the ebb and flow of higher time frame institutional order flow. When price starts to trade back up, eventually it gets into that same bullish order block. Now, what's going to happen is the role of that order block is going to shift to do what? The buy orders in here that are underwater are going to be mitigated. Okay, they're going to be reduced to market orders to get out. Okay, they'll collapse. Okay, so as the market trades back up, those participants that went long in here, okay, that did see eventual losing position there, the way to get out from underneath it is when it trades back up into that order block. Look at the precision. Okay, you see that? Now let's contrast the precision that you see here versus what is classically taught in support and resistance. Here's your low that you'd have your trend line on, okay? And before price trades up, you would anticipate price trading right up into the trend line and stopping right there on a dime. That's what the books suggest, but we can't expect that to happen because we trade inside of the gray area. We're going to allow a certain measure of inherent price action. So now let's contrast that with the precision that is made available also with the bullish order block, bullish candle here, which is the bearish order block, with inside of this bullish order block that's a bearish candle. Okay, in other words, I know I'm probably confusing some of you. If you've cheated and you came to this video series first, shame on you, okay, because you're supposed to be inside of the whole curriculum, going through all the material. But we have a bullish order block here, okay, I'm sorry, bullish candle rather. I'm tripping you all up there. Bullish candle prior to the down move, which is a bearish order block. In other words, they're selling into that. And we have the body of the candle here. Okay. Now what we're going to do is we're going to take a horizontal line between these two price points. We have 158.80, 158.92. What institutional level would you be trading at? 158.80. That would be your sell price. And you can see clearly that's the tops of the candles, bodies right in there. And then ultimately it goes lower. Okay, so when we see swing lows and bullish order blocks fail, when price trades back to them, and if we're in the context of a market structure shift, you'll see these blocks change roles, and they'll mitigate the losing position that the smart money would be holding on to, and they'll unload right there. Okay, and then notice what's happening also. You'll see what everyone used to think I was cherry picking in hindsight back on 80 pips in 2010, where I was showing the optimal trade entries in here. That's the framework of why it took place. Okay, you see that? So that's the nature of the setup and how it unfolds. Let's clear this off and get another whiteboard here. And I want to give you an example of the bullish mitigation. Okay, you see price trades lower here. Okay, you see that? As price starts to make a low and trades down, and then finally this bearish order block, let's zoom in. Okay, the bearish candle prior to the move going lower, which is this candle right here. What we're going to do is we're going to identify that. Okay, and we're going to extend that out in time. Just like that. Okay. Price built a large base of short positions in here by smart money. Price trades down, does in fact take out the low, but ultimately look what happens. It turns on a dime and trades back up and breaks this high right here. So now we have a shift in market structure. So the shorts that were used going down here, okay, are on the water. How did he unload that? Well, when price trades back into the order block here, okay, they will sell. I'm sorry, not sell, but they'll buy back their short positions. Okay, and you see, look at the precision again. See that? Look at the low of that candle. It's lined up with the low of the bearish order block right there. You don't see that precision anywhere else. Not in any other technical circle. It doesn't exist outside of what we're sharing here. Okay. Notice it doesn't get down to a bearish order block here because you're looking at the mitigation of the trend change overall. Okay, so it's implemented during market structure shifts. Okay, it's not just an inversion level. Okay, like a standard key support resistance level you heard me teach about, the last 4.5 years or so. But this is an actual mitigation block where the actual institutional order flow shifts from being sellers. Now they change gears to being buyers. Okay, look at the precision right there. Okay, and then dip one more time. So they were actually buying back at those shorts several times, and then the resulting price action later on was higher prices. Here, okay, see that? And we just covered this mitigation over there. Now, there's one more type of block, and it's a phenomenon that's used to run out stops, and it's very similar to a mitigation block, but it's dubbed a breaker. Okay, and let's take a look at that now. Okay, we're going to talk about a extreme reversal pattern with the order block concept. Okay, and what we're going to be looking at specifically is called a breaker. Okay, and we have a consolidation in here. Price is in consolidation. It breaks up, driving higher, taking out all the stops that would be above the market in here. Okay, and what we'll do is we'll identify bearish candle prior to the rally up, blowing the stops, which is this candle here. Now, this one here can be used, yes, but whenever there's within 3 to 5 candles, if there's another bearish order block that is slightly higher than this one, but worked within the same range, like you see here, this candle's low was inside this candle here, I will use this candle, okay? And this goes with bullish and bearish order blocks as a return for reaccumulation of longs too. So if it's, might want to put that in your notes. If it's a bullish order block or down candle prior to move up, if there is a small move like this, maybe there's 1 or 2 candles, and then there's another additional bearish candle, which is a bullish order block prior to the move, if that secondary bearish order block works within the range of this one as well, I will use the higher order block simply because I believe that's the averaging price that you're trying to get. This was just the early buying. This would be the more uh, accurate depiction of where their overall pricing would be for institutional basis. So this candle's high and this candle's low. Okay, this is a bullish order block that drove price higher. Okay, all the buying orders that was in here were used to surge price up. Okay, and whatever amount of buying pressure was utilized there is unimportant at this moment. But eventually when price turns around and rejects, okay, when we go back into that same bullish scenario here that was used to run the stops, this is the breaker. Okay, we go right back in. All they do is undo what was needed here to run the stops. And then what do you see as a result? A quick rejection and run away. Okay, see that? This is the breaker. Okay, this occurs when the market typically runs stops out. And what will happen is you don't always see this this phenomenon here, which is what is classically shown in ICT material, where we see the high down to the low, retracing up to optimal trade entry. It doesn't do it. It doesn't get to the bottom of this candle, so this would be a supposedly bad setup or a missed opportunity. Well, when you understand it's a climax reversal that you're looking for based on higher time frame premise, intermediate term highs and lows and market structure, this run here, we identify this as the bullish candle, or bullish order block rather, with it being a down candle prior to move up. When we trade back into it here, they'll undo what was needed to run the market higher to take out the stops. This is all you're going to get many times, and that's why you won't get these bullish candles or bearish order block retracements and then selling it up in here. You'll just get these little minor little things, and then it takes off. So that's what's taking place in those instances. Okay, I'll give you another example of a breaker. This is on the bullish side. Okay, we have a consolidation. Okay, price runs down, taking out the low. So there's a raid, and it's a climax reversal. Price breaks here, returns, and reverses the other opposite direction. So we're going to look for the bullish candle prior to move lower, right in here. And we'll extend that out in time. And when price trades back down into it, they're undoing, they're collapsing what was needed to run the stops on the market right here. Okay, and they unwind the shorts to get on the other side of the marketplace to be either at equilibrium or to increase net long positions for a move higher up in the asset. Okay, one more example. We have consolidation in here. Consolidation. They run above consolidation, taking out the stops above here. We focus on the down candle prior to move up. Bearish candle here. See, we have a very similar scenario here. We have a bearish candle, one candle up, and a bearish candle, then a move higher. See that? I'm allocating more attention to this one here, not the lower one. We extend it out in time, and we get true institutional order block and institutional order flow right here, around the 50% mark of that body of that bearish candle, right up in here. And notice also it's coming right to the body low right there. See that? Boom, fills in that right there between the two wicks, fills in that gap, and then trades low. Okay, so what was used to run the stops here went lower, came back up, they unwound the longs in here to get net short or equilibrium or overall price equilibrium in the orders, and moved lower. Now it's not a big move per se, but it's still happening just on a lower time frame, just to show you the same thing is happening on intraday price runs on stops. Just one more and we'll be done with this particular concept. Down candle right here. Prior to the run above the consolidation here, they run it here. This is the breaker. It breaks the market higher to take the stops out prior to the big move lower. Okay, and what we're going to do is we're going to extend that out in time. Okay, price trades rate to the breaker. And what was used to run the market higher, the buy orders in here. When it collapses and runs away, they undo it here. Price trade softer.